Hello everyone and welcome to this week's webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. First and foremost, thank you very much for taking the time to join us. I hope that you've had a good week so far. The markets are certainly looking very interesting right now. There is a number of things which I think are driving the markets at various times. There's a number of economic events this week which we'll touch on now, and then we'll go into some of the more political stuff as we make our way through the charts. First and foremost, though, if everyone could just let me know, or if someone could just let me know that you can hear me, that would be great, so that I don't spend the next 10 or 15 minutes talking to myself only to find out that it's all been for nothing. So perfect. Thank you very much, Debbie. So thank you very much, Tammy. So yeah, it's a really interesting time for the markets right now, and I think the next 5 weeks heading into the end of the year is going to be really, really interesting. To be honest, there's so much which seems to be not necessarily coming to an end per se, but hitting a point at which we start to see some major progress that we haven't had in such a long time. Thank you very much, Luke and Larry. So the Brexit thing is the one that stands out, which again we'll touch on soon. There's also Trump and US and China trade, which again we'll touch on shortly. The Italian situation looks to be getting there. Maybe we'll start to see more of a shift in focus towards some of the more economic events, but at the moment they've been sidelined in favour of the political situation. So you look at a week like this week, for example, and there are a number of releases that we are expecting over the course of the week. They're just not attracting the same attention that they may once have. So you look at, for example, the IFO number from Germany, which was really disappointing, falling to 102. Again, this is a reflection of the fact that the economy is still looking a little bit softer right now. The emissions scandal, which has affected the car manufacturing sector, which is very important in Germany, has had implications for the third quarter, but we haven't really seen a strong bounce back in the fourth quarter data so far. So this is a potential area of weakness for the euro area, but again, we're not talking major market moves on the back of these things. We've got plenty of central bankers speaking this week, and again, one of the reasons why we may not be seeing it having the same kind of impact is because when we look at the various central banks, take the Bank of England, for example, here, it's unlikely that we're going to hear much in terms of policy commitments beyond the 3 interest rate hikes over the next 3 years, while these Brexit talks are still happening and prior to the vote, because ultimately that's going to have the biggest implication for the actual economy and therefore interest rates over the next few years. So it's pointless committing or giving strong indications as to anything else right now. The ECB has quite clearly laid out its framework for ending QE this year and has suggested it will raise interest rates towards the back end of next summer. Now, that is prone to change, and that is likely to change. And I think the weakness in the economic data we've had recently this year, really from the region, is likely to push that back potentially until 2020. But they're not going to change their mind with regards to December. So they'll wait till December, announce the end of QE, and then we may see an update on that side. So these comments that we get prior to that, we may not get too much from. The Fed has quite clearly laid out its path as well. And again, we may see an update in December at the meeting when they raise interest rates again, which is largely priced in at this stage. But it doesn't mean that we'll necessarily hear anything prior to that. So at the meeting, we may hear a slightly less hawkish message, especially if they're going to anticipate slightly slower growth next year for the US, which many people are expecting as we start to see the fiscal stimulus from those tax cuts start to wear off. So despite the fact that we got a lot of speeches over the course of the week, again, Mersh here from the Euro, Raphael Bostic from the Fed, I'm not expecting these to have major market implications unless they say something which really catches people off guard. Wednesday, we've got the GDP figure for the US. Now, this is, I believe, the first revision to it, and we're not expecting any change. So again, we could see slight changes here, but I'm not expecting anything big unless we see a big miss, of course. We will hear from Jay Powell on Wednesday, but reaffirming what I've already said, I don't expect him to say anything too out there, to be honest. More data again on Thursday. Things like German unemployment is always noteworthy. US inflation, I think, is going to be the most notable one because this is the Fed's preferred measure of inflation, the core personal consumption expenditure price index. It's released a couple of weeks typically after the CPI data, and is typically a little bit lower. We're expecting it to dip slightly to 1.9%, again easing the pressure on the Fed. They may point to this if they do decide to slightly lower their forecasts for interest rate hikes over the coming 12 to 24 months. But then income and spending data I always find to be really interesting as well, and it's something that markets do pay a lot of attention to. Later on Thursday, we get the FOMC minutes, but again, we didn't get a rate hike at the last meeting. We didn't get too much of an indication of any change per se, and I think the minutes are going to really reflect that. I think the policymakers were very keen to hold off until that December meeting when they could go into a lot more detail, offer new economic projections, offer a new dot plot, and then they could work on the back of that as opposed to rushing it at the recent meeting. So those minutes could be something of a non-event by the Fed's own standards. Unemployment data out of Japan again overnight is interesting, but it's not a game changer at a time when the central bank is just not keen to become any less dovish and is continuing to buy huge amounts of bonds because inflation is still so low, and it is creeping high, but we're creeping high from a very, very low base. So they've frequently signaled that they're not expecting to change that. Then come Friday, again, more interesting data. I think the Chinese manufacturing and non-manufacturing numbers on Friday could be one of the more interesting releases this week. The reason why is that we know that that the trade war that the US has embarked on with China is having an effect on the economy. We've seen slower economic growth figures, but when we look at things like exports, we haven't necessarily seen that really reflected. And there's two reasons for that, really. One is we've seen a 7-8% currency depreciation in the yuan. So that's going to offset a lot of the tariffs that we've seen put in place by the Trump administration so far. If you think that they put in 25% tariffs on $50 billion worth initially, and then 10% on the 200 billion, which goes up to 25% at the turn of the year. That leaves $267 billion worth of imports, which they will look to put tariffs on later. But it means that most of what they've put in so far is being somewhat offset by the currency moves. The other thing as well is that the most recent tariffs only came in, I think, about a month ago at this stage, and there's a lot of front running in orders in order to try and avoid those tariffs. So you see the companies ordering from China, front running those orders. So you've actually seen higher export figures from China in the lead up to these tariffs being imposed, which has made the data actually improved. It's actually widened the trade deficit that the US holds with China. That will fade off over the next few months, and we'll probably see what the real impact of these will be. Now, the immediate aftermath of these tariffs the data will probably be much worse as you offset the boost in orders prior to the tariffs. But then over the following few months, we should get much better insight into just how big an impact that this is going to have. The confidence figures are already reflecting it, but we need to see it more in the hard data to get a better idea of exactly what that's going to be. And again, China, Eurozone, we've got the unemployment rate release here and the inflation number as well. Again, focus more on core than overall. Overall looks as though they're in line, but things like oil prices do have a big impact on this. And I think the main event this week, and again, this takes us back to the political side, is that G20 meeting right at the end of the week on Friday and Saturday. It's at this G20 meeting that Donald Trump and US President Donald Trump and President Xi Jinping of China are to meet on the sidelines of the event to discuss trade. Now, the tones which we're hearing from the US don't suggest that we're going to see any softening in tone. Trump said overnight in the US that the US is ready to impose more tariffs. There is no plans to delay the increase in the tariffs on $200 billion worth of goods from January. So there's no desire to delay there, and they are prepared with the next $267 billion, which will include things like Apple products, which he specifically alluded to. There'll be a variety of tariffs ranging from 10 to 25% again, and these are going to be the more interesting if we do get to this point, because this basket intentionally includes a lot of consumer goods. They've avoided that where possible so far because they want to have maximum impact on the Chinese economy and minimal impact on the US consumer. Now, this is unavoidable once you start to go into these last batch of tariffs. So that's where we start to see what the implications will be for the US economy if it does get itself involved in a long drawn out trade war that China refuses to back down from. So hopefully these talks can progress positively, but the comments we've heard so far would suggest that this may be long drawn out. We may hear some positive sentiment from Trump, but whether that's enough to actually delay any further tariffs, I'm not so sure at this moment in time, but I think there's going to be an element of risk aversion heading into that unless we hear something on Friday while the markets are still open. So that's the data side, that's the calendar side of things wrapped up. We will head on to the charts, and again we'll touch on the other main events which I've already touched on earlier on. Now you can see with the euro chart, for example, we're still looking a little bit soft here, but there is potential for some upside. Now the softness does stem in many ways from Italy. We have had some, again, developments over the course of this week, over the course of the last week. I think it was yesterday there was reports that the officials within both parties, Five Star and Liga, the coalition populist government, that they are willing to discuss lower fiscal deficits. Now, this is not going to come close to the initial deficit that was agreed between the previous Italian administration and Brussels of 0.8%, but the talk is between 2 and 2.2. So that's a slight softening. There could be further, but I think the important thing is that the tones which we're hearing suggest that while they may be willing to look at this, they're not willing to compromise on promises made during the election itself. So that covers things like a minimum living wage. That includes things like tax cuts. So it's going to be interesting to see where they actually do fill that gap if they do. But it's positive because it shows that they're open to compromise. Whether that will be enough of a compromise initially for the European Commission, we'll have to wait and see. I think it was Salvini suggested that he's one of the deputy prime ministers from the Liga side, suggested that talks will begin with the European Commission next week. So that will be interesting from next Monday. I think this is going to be a long drawn out process. I think we're going to see gradual progress being made on here. I think this will take some of the heat off the markets for now. And that's something that the Italian government are clearly focused on. And I think they'll be looking to avoid too much turmoil in the markets because they do seem kind of borderline in terms of ratings, in terms of yield and the impact that can have long term. So I do think this will be long drawn out, and I think it may go a bit quiet now. We will continue to hear rhetoric because these populist governments do like to talk, as we've seen. But in terms of significant movement, I think it's going to be a number of weeks, and we could even be into next year before we start to hear anything of significant substance. So this is weighed on the euro prior to today. But what's interesting from a technical standpoint is we could be seeing the formation of a imperfect but quite clear inverse head and shoulders. So you can see here that we've got the neckline which comes in around these kind of 114.50s. And this coincides with the previous rally up towards these levels, maybe from 114.60, 114.65. This is where it came to after this initial sell-off down here. The head, therefore, would fall around the kind of 112. So now I know we saw a peak above here previously, but that's what makes this imperfect. The interesting thing is the shoulder initially was around these kind of 113s, and that's where we're currently finding a low now. So it's incomplete at this moment in time. It would be lovely to see a nice rotation back towards these 114.60s, because that's where we'll see a test of just how strong, just whether we are going to see a break of this neckline, because if we do, that would be a nice little bullish signal. And as I always say, the great thing about these inverse head and shoulders, but also things like double tops and everything, is they give us possible price projections. And in the case of the inverse head and shoulders, it gives you a possible conservative price projection, which is typically measured from the shoulder to the neckline projected higher. And then you have a more aggressive possible price projection, which is the head to the neckline projected higher. Again, these aren't my personal forecast. This is very much textbook stuff. But I think a break of that would be significant, because if that then takes us above the kind of 50 and 61.8 fib, that may suggest a further loss of downward momentum, which we're already seeing plenty of evidence of, with the fact that you look at the most recent decline, for example, and you can see that the area on this MACD, the histogram, has been getting smaller with each decline, and you're seeing that this is actually starting to rise up as well on the moving averages also. This is known as bullish divergence, when the momentum indicators aren't confirming price action. Now, that never means that we can't see new lower lows being made, but it does suggest a weakening of the trend. And if we do see a rotation higher off the shoulder now back towards the neckline, that would further support that view. So certainly a potentially bullish signs to be keeping an eye out for here, which would coincide nicely with a quiet spell, maybe even some positive momentum between Rome and Brussels on its budget. Now, the pound is way more volatile, way more volatile, and understandably so. The result of these Brexit negotiations, the result of the votes in Parliament, is going to have huge implications for the future of the UK economy. Now, that may sound a bit overstated, but we may only be talking 2 or 3, 4% of GDP over the next X amount of years. But that is a significant number, and it means, and it's that particularly true in the near term. So that's why we are seeing it so volatile. The projections for where the pound could go in the result of no deal Brexit, or a Theresa May Brexit, or a second referendum, there's so many potential outcomes still at this stage. And I must be honest, the longer this goes on, the less confident I am in my assertion that Theresa May's deal is ultimately going to get over the line. I think for too many MPs at this moment in time, that backstop is just a deal breaker, and it's understandable. I think it was really highlighted actually after this weekend. So this weekend, the leaders from the other 27 countries met in Brussels. They gave their backing for the deal which Michel Barnier negotiated with Theresa May's government, which will allow us to move on to the next stage, such as the vote in Parliament here, etc., the European Council, etc. They gave their backing, and then shortly after, Macron effectively alluded to the fact that we can talk about fishing in British waters as part of the deal later, effectively suggesting that the leverage that the EU has with regards to those negotiations, because the alternative for the UK could be to effectively be caught in this kind of eternal backstop. This is one of the major concerns for British MPs, is that you are going into a negotiation on a future trade agreement, knowing full well that if you get caught in this backstop and you're struggling to find a trade deal that resolves the Northern Irish border, you are stuck in this for an indefinite amount of time, and you have no leverage with which to get out. That is a big deal breaker, and it's understandable as well. I mean, when you consider that so much of this Brexit referendum was about regaining sovereignty, having your own say, self-determination, and we could be stuck in a situation whereby none of that is true, it's understandable that people are very skeptical. The question is, where do we go from there? Do people back Theresa May and her plan because no deal, messy no deal Brexit is far worse? Do they vote it down on the belief that any no deal will come with some form of transition of its own, and the impact of a no deal Brexit will be softened because it's in both sides' mutual interest? Well, I think that would be the way we would go personally in a no deal Brexit. Do they vote it down and call the EU's bluff? Because we have to remember, in the event of a no deal, this backstop is intended to avoid a hard border between the Republic of Ireland and Northern Ireland, which would be necessary when the UK leave the EU if customs and regulatory alignments are not in tune between the two countries. But then obviously that risks the Good Friday Agreement, it risks conflict in the country. So this is something that the EU wants to avoid. But in the event of a messy no deal Brexit, the hard border goes up anyway. So I wonder whether UK MPs are actually going to call their bluff. So when we have this initial vote on the 11th of December, will they vote it down on the belief that Theresa May will be forced to go back and say to the EU, look, you need to give me something on this backstop, otherwise there's going to be a hard border. And this negates the need for the backstop in the first place, so something better needs to be found. I'm more leaning towards that at this stage, but there's so many different scenarios, so many different potential outcomes. There's leadership challenges, there's votes of no confidence, there's votes of no confidence in the government, which would lead to an election, which I see as unlikely because they need 2/3 majority in Parliament in order to do that because of the Fixed Term Parliament Act. There is the DUP withdrawing support for the Conservative government as part of supply and supply and something arrangement, the word escapes me, but effectively the coalition partner. That wouldn't necessarily lead to the fall of the government itself, but it would push them into a minority status. Typically, that would offer the alternative for the opposition party to form a government, but that may not happen. There's many more possible outcomes as well, including a second referendum, which again is still unlikely at this stage, but not impossible. So the longer this goes on, I think the messier it could get and the more volatile it could get for the pound. So I think the pound's looking very vulnerable right now because of that level of uncertainty. The people are looking quite optimistic. We said this in previous webinars. People were looking quite optimistic around these levels. They thought a deal was close. They thought a deal was imminent. They thought, including myself, that this was looking really feasible, that once we start to get real signs that we're going to see a deal, we'll break through these 133s. And that was looking very much the case for quite some time. But you can see here really over the last few weeks, that has very much broken down. While we have some periods of optimism, we've also seen significant periods of pessimism as well, culminating in the more letters being gathered for Theresa May, the potential for resignations, the number of MPs coming out claiming that they will vote against the deal, and this ranges from their own partners in the DUP, lawmakers within the Conservative Party, Brexiteers, Remainers, Labour MPs, SNP for some Scotland MPs. It seems that there's opposition everywhere. So I think there is a lot to play out still in the matter of only 3 or 4 weeks here. And this could even flow over to January as well. So this could get quite messy, but it could also mean plenty of volatility. In terms of what I'm looking out for, I'm looking at these right now and I'm seeing lower highs. So that is one of the reasons why I think cable is looking quite vulnerable. We are also seeing higher lows though, but we are kind of coming down to the same levels. These are higher lows technically, but these lower highs are more significant for me. So I'm treating this almost as a straight line. And I think if we see a break of 127, this could get quite messy for the pound. So that's one thing I'm seriously keeping a very close eye on. To the upside, I think a break of 130 suggests we're back in this kind of range-bound scenario. But unless we see a major step forward, I'm not anticipating a break of these 133s. One area where it's really prevalent is euro sterling. You can see here with such incredible volatility. It's hard to read anything too much technical into this. I think the range still stands, this kind of 87 through 90. We're not seeing any clear signs of a break. We have found temporary upside around the kind of 89.30s. This coincides with that 61.8 fib. That's a speculative moving average. It coincides with the bottom of that rising trend line as well. I'm not really reading too much into it. All that tells me is if we break through there, then 90 comes into focus, and I don't think that's hugely significant at this stage. I think whipsaw volatility is key for me. I think a break of 90 or 87 could be significant, but as with many cases in the pound, I think this is just going to be a very, very volatile period, and unless we see some significant movement, I don't expect an overly significant breakout. The Aussie dollar is really dragging its feet. It's quite a frustrating one right now because we did break out through that falling channel. We did retest it from above, which coincided with that 50 fib, and then we rotated higher and we made a new high. We didn't make an overly significant new high, but we did run into resistance around that highlighted resistance zone, which we discussed in previous webinars. We've come back. We kind of tested 38.2. That's bounced back, and we've seen a bit of softness again. We seem to be seeing a little bit of and ahhing around these kind of 72 levels. I think a test of these kind of 71.80s would be quite interesting. That's where you got the 850 fib coinciding with prior support, coinciding with the 55.89 moving average band lower end. That would be a quite nice rotation point to the upside. It's just not looking as bullish right now as I would have hoped. And you can see, even with the MACD histogram, we made new lower highs when we made a higher high. Perhaps we are going to see another test back towards these kind of 71.50s instead. I remain bullish, but I'm a little bit disappointed that it's not more bullish, if that makes sense. But I remain bullish right now. And if we break through 71.50, then maybe I'll start to really question whether this is playing out as it looked as though it was going to. I still think we can still achieve these 74.50s, 75s, but we'll see how we trade around these levels. And if we do see a break of 71.50, then that certainly starts to look a lot more doubtful, if I'm honest. Dollar CAD continues to grind on frustratingly higher, but we are towards the peak of these levels. So we are at the upper end of what is typically been the range for this pair for quite some time. I still think it's looking soft. I still think it's looking vulnerable to the downside. We look at the recent highs which we've made. You look at that MACD histogram, very clear trend lower. We're starting to see that now on the moving averages as well, and the stochastics looking a bit soft. I think this is looking vulnerable to a break to the downside, so the rising trend line remains key level of interest for me. Well, if and when we do see that break, then again, you're looking at prior zones of support and resistance. So maybe 130, 130 stands out as that initial primary test. But the trend line break would suggest to me that the most recent bullish run has potentially run its course, and maybe there is some potential downside on the cards, really, for this cable pair. This has been a very sharp correction from those highs, and anyone who follows this will know that I'm generally quite bearish the dollar over the next few months. I think we're taking a bit longer to get there, but I think that's because the fundamental factors which makes the dollar bearish for me are materializing on a much slower basis. And I think even Brexit could be one of the main factors which is hampering the moves. But like I said, interesting few weeks ahead. I'm keeping a very close eye on that trend line. If we do break through these kind of 134s, then we'll see if that is matched with a momentum shift here. If it's not, then I remain a waiting bear, a sitting bear, should we say. Sterling CAD's just really volatile. I mean, how do you read too much into this? One interesting thing is we did have the break of that head and that double top here with the neckline coming in around the 169.30s. We did see a break to the downside. We've seen a bit of a corrective move. But as you can see, from the recent highs to the recent lows, we rallied back. We went through that initial resistance. If you see a bounce off the neckline of that double top, that's typically seen as being as confirming the initial breakout. A nice little bearish move. We went through there. At that point, I always look at the Fibonacci levels. 50 held initially, but then we broke through, but that 61 has held quite nicely, and now we are back at new lows being made today, and this is looking a bit soft, so I think this is still looking weak. I still think we can see a move back towards the bottom end of this range, but as ever, it's a pound pair, so it's volatile, it's prone, very prone to Brexit related news flow, which is frequent at this moment in time. Kiwi dollar's played out much nicer than the Aussie dollar. So already we've seen a nice little rally to the upside, strong rally to the upside. We've come back up towards this zone, which we were eyeing up initially around the kind of 50 fib, because that's where it coincides with the 200 and 233 day simple moving average bands. We've bounced off the 200-day simple moving average to begin with, and then we've kind of consolidated lower. But this is still looking nicely bullish, to be honest. We are seeing warning signs because we are seeing divergences starting to appear between the momentum indicators and price action. I still think there's potential for another move to the upside in price action, though, into the 200, 233-day simple moving average band. And then the 50 fib of that long-term move could be an interesting test here. If we don't see that, and if we do see a rotation to the downside, I'm very keen to follow these this 38.2 to 61.8 fib zone, because we've seen a nice rally out of this falling channel. This looks quite bullish still for me in the medium term. But so if we come back into this kind of fib level, I'm very much going to be looking to see if we do see any nice rotation points, to see if we do see a nice challenge that could potentially suggest to us that we're actually heading beyond where we've achieved so far, potentially even beyond the 200 to 33-day simple moving average range. And that would coincide nicely if that kind of dollar weakness does materialize. So short-term weakness in this could be positive as long as the long-term trend, as long as we see some bullish long-term trend sign. And if they appeared in there, that would be technically very nice as well. Dollar yen is, I mean, I don't really know where to go from here on dollar yen. The channel I keep trying to play with, I keep looking at, I'm trying to look for signals, but it's just not clear for me right now. So as far as I'm concerned, I'll take that out. It's not giving strong enough indications, and we don't really need it. We've got the 55.89 moving average band coinciding nicely currently with the Ichimoku cloud, and that's providing nice unique and significant signals here, because we found support around those kind of levels and the moving averages when it coincided with the 200 and 233-day simple moving averages here back in August. We scaled above the red moving averages here, and where the 55.89 coincided with the bottom of the Ichimoku cloud, we rotated higher again. We've rotated higher off those levels again here back in mid-October and late October, and we're back in that range again, and we've rotated higher. Now, what's really interesting for me here is we failed to make a new high last time. So that's a potential sign that of a weakening trend. So the most recent rally, I'm keeping a very close eye on this previous high and this previous high here. If we fail to breach either of those, then this trend starts to look weak. And I'm very much keeping a close eye then on these kind of 112s, because if we rotate lower from a lower high here, then these levels could start to look very vulnerable. And if a break of 112 takes out the 55.89, which has proven very nice and reliable for quite a while, through the Ichimoku cloud, which has also proven a nice, interesting level sometime, then this starts to look very vulnerable. And again, you're looking for levels of potential support beneath that. You could look around the kind of 111.60s, which is resistance throughout this point, but also support around these kind of levels, 111.50, 111.60. Below there, again, you're looking at these kind of 110.25s, 110.30s. We've got the 202.33. I'm wondering whether this is starting to look a little soft. And again, you'll notice the dollar story coinciding. It may take a bit of time to play out, but this could consolidate a bit more. But I'm starting to think that this looks a little bit vulnerable, if I'm perfectly honest. And again, the fact that it coincides with other analysis as well is always good. I mean, sterling yen is just so volatile and so choppy, but we've got this nice little range at the moment around 142.50 through 150. We're just bouncing between those ranges. We're very news flow driven. We're very risk driven. The yen risk trend very much playing a factor here. When risk is being driven off by Brexit uncertainty, this just really plays nicely into this hand, and same with risk returning. But I'm not looking too much into it beyond that, just because it's just so choppy. So we're in and out of the Ichimoku cloud. We're in and out of the moving averages. We're sideways trending, which is never a good trend signal. When I've got so many trend signals on here, that just really starts to look quite messy. The one thing I would say is that we are making higher lows here in the price from for a sterling perspective, whereas the peak around 150 is holding solidly. So that potentially is a bit of a bullish signal, suggesting that while people are a little bit curious and the outlook for the Brexit negotiations are unknown, that underlying mild optimism still exists for now. If we start to see that broken, then potentially that's a sign that has very much changed. But at the moment, that's what I'd say. It's still, though, very choppy. Euro yen's the same. I've added a couple of trend lines on here as potential levels of interest, only because, yes, we breached this one briefly here, but you can see here and here we've touched this kind of trend line, which again just highlights the consolidation in this pair. Same from above. We've had 3 or 4 touches, 5 touches from above, but clear consolidation. I'll be interested to see if we break out of here, just how aggressive a move we can get, because sometimes these periods of strong consolidation can be followed with bursts of energy. So that could be a burst to the downside, a burst to the upside. This is what I would call as a triangle, which doesn't necessarily give you any directional bias. Again, we're kind of still range bound to an extent around the 133 through 125, wide range. But I mean, how else can you describe exactly what that is? It's choppy, it's range, so that's consistent. But a break through one of these trend lines may give the signal that we're looking for. It may not. I've seen plenty of occasions where this chops through. It looks like it gives you a signal, then it just keeps carry on chopping and you move on. But at the moment, that's what I'll be keeping an eye out for. But it's not one of my favorite charts by any stretch of the imagination right now. It is what it is, but there's more interesting things out there as far as I am concerned. Okay, so that is all we've got time for this week. Next week, we've got a special webinar just for live account holders. I will be joined by our Vice President of Market Analysis, Dean Popplewell from Toronto. So we will be discussing all the major market events for the month of December. So we will be talking about the Brexit developments, but we'll also be talking about things like the Fed meetings, about OPEC. Not about OPEC. That's well, we may talk about OPEC actually. It doesn't have to be just FX in this one. It's an hour long, so it's a special hour-long webinar. And it will probably not be going up straight away either on YouTube after. So if you have got a live account, please do sign up for that. We'll also be taking questions. So there'll be a Q&A session, so you can ask us whatever you like, and we'll try to answer all the questions that we can. So like I say, please do sign up for that. Hopefully you'll find that one interesting next week as well. Finally, do just follow us on all our platforms. So check out MarketPulse, where you'll see the economic calendar we used earlier, but also all our day-to-day market analysis from the various analysts across the region. You can also follow myself on Twitter. It's Craig_Forex. Ask me any questions you've got from today there. I'll be always happy to help. And then finally, check out our podcast series. So we've got the OANDA Market Insights available on iTunes or Android. At OANDA Market Insights, that's released every Friday afternoon, giving an overview of the week just gone. And then there's Alfonso's podcast as well, which is OANDA Market Beat, that's released in the middle of the week. But apart from that, I think that pretty much covers everything. Only thing left to do is wish you all a fantastic week. I wish you all the very best of luck with your trading, and I'll hopefully catch you all again at the special webinar next week, and then we'll go back to normal the week after, when I may even be joined by another colleague from New York, which we're just sorting out at this moment. But again, thank you very much, everyone. All the best of luck, and I'll speak to you all again very soon. Cheers.